we're going to move on to your research on active share, which I think is what you're probably best known for. At least that's how we knew who you were initially before reading all the rest of your stuff. Uh, can you talk about the main ways that an active equity manager can be different from the index in an effort to try and beat it?
Yeah, there are many ways that active managers can try to beat the benchmark index. You can distinguish, for example, managers who focus on factor and market timing, including sector exposure, sector rotators, versus a very different type of manager that focus on individual stock picking and security selection in particular. I think that's the dimension that ActiveShare is really only focused on, is how much security selection a manager is doing. Regardless of the particular style, all managers need other skills, like trading skills, liquidity skills, tax management skills. And again, ActiveShare is really focused only on what I think of as security selection skills.
How does ActiveShare measure how active a manager is?
ActiveShare is a very, very simple measure, very basic. It compares the holdings of a fund to the holdings of the fund's benchmark. So it's a purely relative measure, fund versus its benchmark. So any security that is both in the fund and in the benchmark, in a long position, will create some overlapping weight, which is the minimum weight across the two, right? Weight in the fund versus weight in the benchmark. For example, if a stock would be 4% in the benchmark and 6% in the fund, then the minimum or overlapping weight across the two is, of course, 4%. Then the fund, the actively managed fund, has a 2% overweight in the stock. Then to calculate ActiveShare, take all of the securities that are in both the fund and the benchmark, calculate the overlapping weight of each, then sum up all the overlapping weights across all the stocks that are in both, and detract that from 100%, and you have ActiveShare. In other words, ActiveShare is the percentage of weights or holdings in a fund that is not one-for-one overlapping with the weights in the holdings in the benchmark. So my view of ActiveShare is then it's a measure of how much security selection of individual stock picking a manager engages in.
And what made ActiveShare a valuable contribution to the academic finance literature?
Yeah, we published a paper in 2009. We made our first version available in 2006. It was actually the first paper I ever wrote on mutual funds. So if you read the paper, please forgive me. It was my first ever paper. My co-author had done a couple of papers on mutual funds already. It was my first ever mutual fund paper. What made I think valuable is ActiveShare is a very, very simple basic measure, but it allows you to differentiate funds by looking at how much stock picking a fund manager is actually doing. So if you are looking for an active manager, right, it's useful to know what part of the fund is actually different from the benchmark. And so if you want to look for a fund that does a lot of stock picking, right, does the fund then indeed have a high ActiveShare? More generally, even if you're paying high fees for a fund, you would want that fund to be different than the benchmark and thus not have a low ActiveShare. And that's also how I think our paper initially got a lot of attention, because one of the things we documented in our paper, and our data ended in 2003, so this is a long time ago. But at that time, we found that a large percentage of the market in US equities, especially large cap US equities, had very high fees and had very low ActiveShares, right? The largest equity fund at the time, the Fidelity Magellan Fund, they had an ActiveShare of 34%. So 66% of the Fidelity Magellan Fund at that time, right, 2003, was one-for-one overlapping with the S&P 500.
Yeah, that's wild. Did you guys come up with the term closet index fund, or was that?
And we did not.
Okay.
No, we came up with the term ActiveShare.
Okay.
Yeah.
Yeah, interesting. Because closet index funds became, and I think probably still are, a pretty big deal. How is ActiveShare different from tracking error?
Yeah, so tracking error is a traditional measure of active management. So both measures look at how the fund is different from the benchmark. So ActiveShare looks at portfolio weights, the holdings, and is based on a snapshot in time and completely ignores returns.
Hmm.
Right? And so therefore, ActiveShare also completely ignores any cross-correlation structure between these securities in the funds and in the benchmark and everything else. So tracking error considers the difference in returns, or is the volatility of the difference in the return of the funds minus the return of the benchmark. So tracking error is based on historical returns and is also backward-looking, not a snapshot in time. So the two measures, I think, can be very fruitfully used together. They're not competing measures. They are positively correlated, but not that much. When I calculated in my samples, the typical rank correlation is 20-25% only. I think. So it's not that high. So yes, if you know the ActiveShare or the tracking error, you have a sense of what the other could be, but it's still a lot of variation. And it's very fruitful, I think, to combine them. For example, if you think about ActiveShare and you think about the active overweights and underweights, or the active bets, right, that a fund is taking, you can ask, well, how well diversified are those active bets? And if these active bets are very well diversified, then a fund can have a high ActiveShare, but not that high a tracking error. And if the active bets are not well diversified, for example, if a fund focuses on a certain style or industry or a particular factor, then a fund can have a high tracking error, even if it does not have a high ActiveShare. And that's actually the case, I think, for many of the factor investing funds out there that often have not that high in ActiveShare, but significant tracking error.
What is the ActiveShare cutoff for a fund to be considered a closet index fund?
That's, I think, somewhat subjective. The ActiveShare helps you to figure out what part of the fund is actively managed, right? What part of the fund is very different. But the right cutoff is to some extent subjective, but I'm glad to share how I think about that. One important consideration is to recognize that it really does matter what type of securities you invest in. For example, for large cap funds, the benchmark is more dominated by a few very large stocks. And so I think you would naturally expect a lower ActiveShare than for small cap funds. Because if you want to some extent, give your investors what they're looking for, right, exposure to that space, you have to have some overlap with these large names. If you take a couple of steps back and you're considering a fund that is focused on stock selection, a very basic question to ask is what percentage of the assets in the fund's benchmark universe can outperform? So if you assume, which is not the case, but if you assume that stock returns in the cost section are strictly symmetrically distributed, then you would expect that about 50% of the assets weights would outperform, 50% underperforms, right? However, stock returns are not at all symmetrically distributed. They're quite positively skewed, right? Where a small number of names have very, very high returns, and a typical stock actually underperforms. So that means that considerably less than 50% of the assets in any benchmark will outperform. And if it's skewed enough, as for large caps, maybe only 40% or even 30% of the assets would be expected to outperform, and the rest will underperform. And so if the task of the fund manager is to find stocks that outperform, right? You want the fund manager to think that I'm going to need to look in that 30 or best 40% of assets. And then going back to ActiveShare, that would translate into an overlap that cannot be larger than 30, 40, or 40%. And so you want to end up with an ActiveShare of at least 60%, or maybe even at least 70%, using that logic of the active manager should be looking for stocks that are going to outperform. And the manager cannot think rationally that, let's say, more than 40% of the assets in the benchmark will do so.
Do you have a sense of what proportion of active funds today are closet index funds?
So you need to define a cutoff, right? So let's say 60%. That proportion has changed a lot over time. And it also differs very much by fund style and asset class. Very few small cap funds have a low active share. So among the closet index funds, almost all of them with active shares below 60%, almost all of them are going to be large cap funds. That's an aspect of the market that I don't think I appreciated when we wrote our initial paper, right? That was not our focus at all. So closet indexing is most prevalent among large cap funds. It was quite uncommon until about the mid-1990s. So there were almost no, even large cap funds with active shares below 60%, even in the early 1990s. And then closet indexing became quite common, especially leading up to the early 2000s. When we wrote our active share paper in 2009, our data ended in 2003. At that point, maybe a third of assets in US equity funds were in really low active share funds that you could classify as closet index funds. Since then, something very interesting has happened. On the one hand, the assets in really low actively managed US equity funds has dropped. So closet indexing, let's say active share below 60%, has become less common. At the same time, the percentage of assets in funds with really high active shares, let's say 90% or above, has not increased. It has seen a slow continued decline. So in other words, the aggregate or average active share of equity funds in the United States has continued to trend downwards, roughly speaking, for the last 3 decades. And more funds now are somewhere between 60 and 70% active share.
How do you describe the concept of a fund's active fee?
Yeah, the starting point for thinking about active fee is to relate the fees that you're paying for how much active management are you receiving. So exposure to the market, again, for US equities, is of course very inexpensive. So beta needs to be cheap. Investing in broad-based market indices should be low cost. So higher expenses, therefore, should reflect that you're receiving more active management. So how can you interpret whether the level of fees of any product is appropriate without understanding how much active management you are actually receiving in the product, right? And that's where active share comes in as a basic measure of how much security selection a fund is doing. So that brings up the active fee, which we define as the ratio of the level of expenses of the actively managed funds divided by the active share, the ratio of that. In the paper, we define it more precisely as how much more expensive the active fund is relative to the passive fund, right? So the difference in fees over the active share. So it's in my mind, a proxy for the hurdle rate or how much the active manager has to outperform by to earn back the higher fees that the fund charges. So maybe I can go through a very simple example. So let's say an actively managed fund charges fees that are 100 basis points per year higher, as just a simple example, than it costs to invest in the fund's benchmark. So then the hurdle rate for that manager is that that fund needs to outperform by at least 100 basis points per year on average, right, to earn back the higher level of fees. And then, as just an example, say that the fund has an active share of 50%. That means that half of the holdings of the fund are 1-for-1 overlapping with the holdings of the benchmark. Now, of course, it matters which holdings are overlapping, right? But the overlapping holdings themselves won't help to earn you back the higher fees, right? And as a simple example, and completely ignoring risk now, let's say both the fund and the benchmark have 5% invested in Apple stock, the same weight. Then whatever the performance of Apple stock is in the market, ignoring diversification and risk for the moment, it will affect the fund and the benchmark identically because they have the same portfolio weight, right, in Apple stock. So whatever Apple stock does is not going to help the manager earn back the higher fees. So the fund can only earn back the higher fees to the extent that the fund is different than the benchmark. And so with an active share of 50%, that's only half the portfolio. So you can then think about the hurdle rate of the active part of the portfolio, the active share of the portfolio. right? And that's why you divide the difference in fees by the active share to get the active fee, which in my very simple example would be an active fee of 200 basis points per year.
Yeah, it's really interesting. It's like it's the fee that you're paying on the active portion of the portfolio. Is that a way to think about it?
Exactly.
So if you're paying an active management fee on a mostly closet index fund, you're paying a really high fee for the portion that's active. Yeah, that's interesting. Because you're paying active fees on beta for a portion of it, which means if you separate that out, the amount that you're paying just for active could be really, really high.
Yeah, that's
exactly. It's also a way to compare fees across very different products. You always have to be careful with interpretation. At the first level, exactly as you said, I think of it as how much are you paying for stock selection? If that is the main thing that the fund is doing.
Yeah, that's makes a lot of sense. It makes a lot of sense how that could be very different across funds. Is there a relationship between fund size and closet indexing?
Yes, but only for really large funds. And so many of the really, really large funds tend to have lower active shares or even low active shares. Their fees also tend to be lower. So again, you have to adjust for that. But we did find that the very largest funds are more likely to be closet indexers. But if you take the very largest funds out, then we didn't find a strong relationship between fund size and closet indexing.
And how do closet index funds perform compared to the more active peers?
Yeah, I think that's probably the main takeaway from that our first active share paper. I think of it as the strongest and most robust prediction I have. Is that closet index funds tend to strongly underperform with strong statistical significance. They typically underperform if you form portfolios of closet index funds by about the fees that they charge.
That's interesting. So do I infer correctly from that it's that research was less about like, hey, active share predicts positive performance from high active share funds, but more so that it predicts negative performance from closet index funds?
Yes, if you go back to our 2009 paper, we had a very strong statistical result on the low active share funds. And then we had we did have a result that the high active share funds as a group outperformed, but with much less statistical confidence.
Wow,
and,
yeah, okay.
and then we had a third result, which I think is also a very robust result, which was that we found strong positive performance persistence among the high active share funds. So high active share funds that had strong outperformance in the past, that they were more likely to continue their outperformance in the future. So I think two of those three results, I think, are fairly robust. The one result that has not been very robust is that the average or the typical high active share fund outperformed. That was true for a particular time period. That is not proven true since then or over the full period now measured.
Okay, interesting. So the strong performance of high active share funds in the sample in that paper looked pretty good, but out of sample it has not been so good?
Exactly. The other result is that the combination of high active share and strong past performance, that leads to continued strong future performance, that has been robust as far as I know.
Yeah, okay,
so it's the unconditional high active share, right? If you don't combine active share with anything else, then you don't find in recent decades that the average high active share fund has outperformed. But the positive performance persistence, as far as I am aware of, has been robust.
It probably related to persistence. How persistent is active share as opposed to performance, but active share itself?
For a typical manager, active share is quite persistent. So we look at 5-year periods of time where the typical fund stays in its active share decile. So it's quite persistent. There's some mean reversion, but very slow. Tracking error is much more strongly mean reverting. And so active share is quite persistent. You see significant changes in active share when a fund massively changes its size. Typically, when a fund size goes up a lot, you see active share often, not always, but often come down a bit. And when the manager changes or the whole management team changes, you may see some significant changes in active share as well.
Yeah, okay, interesting. I was going to ask about that with the like the Burke and Green 2004 idea that money flows to skilled managers to the point where they can no longer express their skill effectively. Is that kind of that idea where when a fund gets really, really big, its active share goes down?
That is what we find, yes.
Yeah,
Yeah,
okay,
that is not a strong result unless the fund gets really big, though.
okay.